It is coming. And don't forget, for employers stroke employees, it's really a 2% rise, because there's 1% for the employer and 1% for the employee. You know, so national insurance going up. Bad thing, bad thing. So the point about the jobs tax is that the headline rates only tell half the story. The other half of the story has to be gleaned from where the rates are set. And what they are telling us, and we don't know quite how true it is because they haven't published the actual detail on this yet, is that for employers, only employers, the starting point is going to be jacked up. And by jacking up the starting point, you pay less national insurance contributions. And it's stating the obvious, isn't it? You know, if the first bit doesn't attract it and you make the first bit bigger, then more of the salaries don't attract it. What else have they said? Well, they've sort of said that they will try to protect the lower paid employees from this as well. So they're talking about increasing the threshold for employees generally. But if they just increase the bottom threshold for employees across the board, that doesn't help lower paid employees. It helps all employees, of course. And they've told us that it's only lower paid employees. So you don't have to be a genius to deduce what else is going to happen. The top threshold is going to come down a bit. So, no, not down a bit, I didn't mean that. Go up a bit, that's what I'm looking for. I said down, I meant up. Go up, so that more of a higher paid employee's earnings will be subject to the higher rate of national insurance contributions. Currently it's 11, will be 12, than the lower rate, currently 1, will be 2. So that is what we're going to see. We're going to see a lot of meddling with the thresholds. And no doubt I have immense faith in computer systems. I'm sure the payroll systems will cope with all this. Just like the revenues computer system copes with coding notices and all stuff like that. But it's going to make a bit of a muddle about it all. But well, that's it, isn't it? That's where we are. But you know, the key thing is the actual absolute rates have all gone up by 1% across the board. Now, a few more things. If we just skip through these very quickly, and then we'll get to the planning points that you've been begging for. On capital allowances, we have two initiatives that were announced by the coalition government in the budget, putting aside the ones about no emission vehicles, but the annual investment allowance. It was introduced at £50,000. It was then increased to £100,000 by Darling in his last move, and we are told that it will now tumble to only £25,000 from April 2012, which is a bad thing. We're also told that the rate of writing down allowances will be reduced again from April 2012, which is a bad thing. Why are they doing it? It's part of the manoeuvre to reduce headline rates of, well, particularly corporation tax, not income tax. Income tax isn't coming down, but corporation tax is, and as a quid pro quo, reducing certain allowances as well. So that's what's going on there. So a few other quick things, not so quick perhaps. Inheritance tax. The other big tax that the election was sort of being fought upon. The Labour administration froze the inheritance tax nil rate band. £325,000. It should have gone up further. It should be £350,000 now, but it was kept at £325,000. The Tories said, we'll make it £1 million. Vote for us, we'll make inheritance tax threshold £1 million. They were a bit cagey about whether they meant £1 million or £500,000, because they had previously sort of bandied around £1 million. And then the Labour government in October 2007 introduced the concept of a transferable nil rate band. So if spouse 1 dies and leaves everything to spouse 2, when spouse 2 dies, spouse 2 now gets 2 nil rate bands. Very good, fantastic. So it was never clear to me whether the Tories' million was really 2 lots of £500,000 or whether it was 2 lots of £1 million. But anyway, we need not worry about that too much now, because we know what it is absolutely. It's 2 lots of £325,000. And it will stay that way for the life of this Parliament, we are told. That is what was in the fabulous coalition document, that they are freezing the inheritance tax threshold to help pay for the increase in the personal allowance and the staving off of the dreaded jobs tax. So inheritance tax has been chucked on the compost heap, really. Not only that, inheritance tax is being made the subject of consultation on how it can be brought within the rules which I have labelled there DOTAS. DOTAS, what the hell's that, you shout? Disclosure of Tax Avoidance Schemes. That's what that means. In the 2004 Finance Act, rules were introduced so that if you dream up a fabulous scheme, if it fits the bill in certain ways, trips so-called hallmarks, you have to tell the revenue all about it. And when you tell the revenue all about it, what do? They turn their biggest guns on you. That's what they do, and attempt to blow you out of the water. And I will share with you a personal piece of grief, which is that I'm at the tribunal tomorrow, dealing with one of the scheme that we had to disclose under DOTAS. And the revenue didn't say, oh yes, that's fine, congratulations, well done. They said, we'll see you in court, and tomorrow is the day of days. So inheritance tax, not much there. Pensions, I've sort of touched on pensions a little bit, but they've said sort of 3 things. That, what do people hate about pensions at the moment? They hate buying annuities at 75. They've said, oh, we're going to stop this, but we don't know how to do it. But what we'll do in the meantime, while we're consulting on it, we will do away with the requirement until you get to 77. So anybody coming up to 75 gets another 2 years grace while the consultation process goes on. Hopefully that will produce some kind of robust ongoing regime which will be attractive to people. The penultimate point there I put is, what about the 82% rate of tax? Because at the moment, if you get beyond age 75 and are in drawdown and drop dead, the combined rate of tax in getting the fund down to your heirs and sons and daughters is 82%. Nothing was said about that. I'll be interested to see what develops on that. But the final point is the critical one. And it is that the new pension regime, which I banged on about earlier, from the 6th of April 2011, has been kicked into the long grass, or been kicked further than that. It's been kicked off the edge of the precipice, because in Finance Act 2010 number 2, they said we are not going to implement the pension proposal from the 6th of April 2011. Instead, we are going to consult on what we're going to have in there to replace them. And what they are talking about at the moment is having a massively reduced annual allowance. At the moment, the annual allowance is £240,000. So you could put into your pension £240,000 and get tax relief on that if your income is high enough, subject to all these transitional rules. What they're saying is, let's bring it right down. So you just can't put that money in. Which, I don't know. I mean, I thought the idea was to encourage people to put money into pensions, not to stop people doing it. It seems a bit odd to me, but there you go.